Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Welcome from the Innovation Studios at the Rick and Dawn Duquesne Innovation Studios right here in Duquesne Hall. Today, we have a monumental special guest. Today, our special guest is Russ Ramsey. Russ Ramsey, welcome to Market News with Rodney Lake. Thank you so much for being on the show. I'm going to say just a second about you, and please add some more to the intro here. But you have been a foundational member, the founding member, really, for the GW Investment Institute, which obviously I serve as the director of currently. And you have a rich history at GW. You're a GW alum, which we'll get into here a little bit. We're very delighted. I'm very grateful that you're willing to spend some time on the podcast today. But you started here at GW. You went on to do many things, including founding your own business, FBR, starting your own asset management company, Ramsey Asset Management. You were put the seed money in, you and Norma, for the GW Investment Institute, which has become $10 million today, and we'll talk a little bit about that. You've done a lot in the world of philanthropic gifts and other activities. And you're a busy person, and you're doing lots of really cool things. So we're very excited that you're here. So number one, so we know you're a GW alum, but maybe let's dive in a little bit to the origin story. How did you get to GW?
Well, Rodney, thank you. I'm very excited to be here today. I am just incredibly impressed in your commitment to the university and your creativity and what you have done to, take our little vision 19 years ago and turn it into really, there's nothing like it in the United States of America, as best I can tell, or for that matter, the world. So I'm really delighted to be here.
Thank you.
And, George Washington University is a very special place for me. I think, as you know, I was the first in my family to go to college.
Yes.
A wonderful man named Mike Toomey offered me a scholarship, and it really changed my life.
Yeah.
Even though I had been basically born and went to high school in suburban Maryland, coming down to the Foggy Bottom, being exposed to the dynamic, even then, very dynamic energy around campus, the diverse nature of the place. And, we were playing Division I baseball and experiencing the challenges of playing on what I lovingly call the worst baseball field in America, which is the ellipse.
I think not many people know that, by the way, that you guys actually played on the ellipse. I think when we say that to people, now they think it's a joke.
Correct, but it was real time. And, and in some respects, when you first go down there, you're just in awe because you're looking around and there's the White House and the monument. And on any given day, there could be, a presidential helicopter coming in and everything stops and they make you sort of side. But then when Penn State kind of rolls in and you've got a doubleheader, that is kind of the key to maybe you going to the postseason, and all of a sudden you realize that you've got no fences, no foul poles, no dugouts, no bathrooms. But other than that, you have everything you need in order to compete, and no field crew. But it was, listen, it was a wonderful experience. Yeah. And as I was sharing with you before, we just had the awesome experience of the university's Hall of Fame inducting our entire 79 team into the GW Hall of Fame because it wasn't quite a couple outs from going to the College World Series, but we lost to Arkansas in a 12-11 thriller, and they ended up going into the final game undefeated. And, we were in what's equivalent today of the Super Regionals,
right?
Which had teams that we just didn't ever imagine we'd be on the same field with that were there: Florida State, Arkansas, Seton Hall. It was quite a memorable thing, and it goes back to the theme that you are so incredible with your students. Which is, really urging them to stay connected, like right from the beginning.
Yes. And
staying on, and in our case, bringing that group together after a long time. Was quite something and quite special. So this place is very special to me, and my degree here really was a very important sort of first step in me, giving me the ability to find some success.
And you studied business, just for everybody who didn't know what you studied. So obviously being in the business school is apropos here. So you studied here at GW. First one in your family, as you mentioned, to come to college. What do you do next? So you leave GW, you have a fancy degree now. You had a really good time playing baseball, really outstanding times for the team, and great that they got inducted. That's a wonderful story, and being back on campus after decades is a really wonderful setup. And as you mentioned, as I encourage all my students to stay connected, we just did an event for our Ramsey Scholars, which we'll talk about a little bit. Now, what's next? You leave 1981, which is a great vintage for everybody out there at GW history. 1981 grad. What's next?
So my story is my story, and I could sugarcoat it. But the reality was I wasn't a particularly attentive or good student. I was here because I wanted to be Pete Rose. I wore 14. I dove head first.
Nice.
I didn't gamble and still don't.
Right.
But he was personified what hard work and hustle was all about. I'd run full speed to my position. If I walked, I would run full speed down to first base. People would sort of roll their eyes, make fun of me, but I would look in for any kind of an edge to try to get up on the competition. And so I always knew the value of hard work. Mm-hmm. And while big league baseball wasn't in my future, when I graduated in May of '81, I realized that I really didn't know how to do anything. But I did know the value of hard work, and I had actually turned around my very bleak academic record my last 2 years and finished with a decent GPA, and set out to sort of pay off the student loans, which my scholarship didn't cover. And so the reality is I didn't know how to do anything, but I knew how to work hard, and I ended up getting a job in sales and spent the first 4 years of my career literally going door to door selling office equipment, postage meters, and copiers, and ended up with a great company called Pitney Bowes, which was really a quite well thought of company at that point in time. And they were very good about taking hardworking people, giving them a little bit of an opportunity, and that was another key important break for me.
And when you were there, you're doing sales, which is your front line. You're talking to people directly. Yeah. What are some of the takeaways that maybe you could share with everyone, that lessons learned from that time period, and that were helpful later in your business career?
Well, sure. And even someone that was perhaps more attentive academically than I was, regardless of sort of how you went about it, I selfishly believe everyone should start in sales. And if you have a very specific degree, you're an engineer or you're an accountant, or you want to go into academia, or you want to go into perhaps philanthropy. But away from that, I encourage everyone to start in sales. Why? Because that's how you figure out who you are. Mm-hmm. That's where the rubber meets the road. It's where the customer interacts with the product or service. It's where that frontline individual who's responsible for getting the order, getting the installation, making the customer happy. You find out like what it's all about and what you're passionate about. In my case, I love commission sales. I love being, basically being able to chart my own destiny.
Right.
And I loved that, every aspect of that. And I think it's probably why I basically ended up as an entrepreneur. That was really the last job I really had. Nice. But at the same time, I think it's also where I think people can then find out what their passion is. They want to focus on all the financial aspects. They want to be in supply chain. They want to be part of manufacturing and research and building new things and creating new products. They want to run it. They want to be part of HR. They want to be the CEO. I never wanted to be the CEO of a big company.
Yeah.
Because of the way the compensation worked, I didn't want to take a pay cut. But it allows you to kind of know who you are.
Right.
And then just to keep the segue going, this goes down to the value of relationships. Right. I went in there, wet behind the ears, didn't really know anything, and met the group and the team. And Pitney Bowes was very smart about how they incentivized and their brand. They had a branch system. And as I was coming in, the sort of top producer and someone ever really looked up to was Eric Billings.
Yeah.
Who was in the future, one of my partners at Billings Ramsey. And
so the origin story for FBR, which we can get into.
Sure. So Eric was had finished what he was doing and was on his way to, Legg Mason and Bill Miller and a whole nother sort of journey before, we all came back together. And but it's the value of relationships and seeking out mentors and people who are willing to share how they do and what they do.
So now let's fast forward a little bit. So your first job out of school is sales. Learn a lot in that. I also agree that when you're that front line piece, you learn a lot of great lessons, and you definitely learn what it takes to build a business and grow it, because every business needs revenue at some point.
Yes.
And so that's a key trait a key skill for especially a leader of an organization, which you go on to do, has to have. So if you want to add anything else, please do here. But then let's start talking about the formation of FBR. How did that come about?
Sure. So, so I mentioned Eric and our friendship, and that has endured, forever. And we were friends. I was always interested in the stock market. 1981 was not a great time to seek employment.
Right.
And the truth was, I really couldn't spell Wall Street. It wasn't like that was really something that I'd spent my life thinking about. But I started getting interested in the markets. I started getting interested in equities. Eric had been very, very innovative and successful, and had gone to Legg Mason, which at the time was really a regional sort of brokerage firm,
Right.
but had this teeny little mutual fund called the Value Trust, which a guy named Arnie Keeney had started, and Bill Miller, who was the then director of research, and Eric used to call on accounts, throughout. Boston and New York, and do the same thing we basically started FBR with, which was to try to, sort of get paid for your stock research.
Right.
And Eric had become quite interested in the kind of savings and loan industry and the kind of mutual savings and loan to public ownership, which is a whole another story about one of the great places to have asymmetric sort of risk reward investments, which really doesn't exist anymore. And Eric had become very successful in getting to know Peter Lynch at Fidelity. And Peter, if you go back to the heyday of Fidelity Magellan, Peter loved these savings and loans because they traded at prices you never see today. They'd come public, they traded 50% of book value. They were, riskless investments. And he was, even then, Magellan was big enough that he couldn't buy one; he'd have to buy 100.
Right. All of them.
And so we started to become interested in those, and I kind of got the bit in my mouth, so to speak, with the market, and that was kind of the beginnings of kind of our business.
Nice. And so, very curious to maybe dive in just a little bit more. So, what were the initial sparks? So, you went from not paying attention to Wall Street to obviously leading a firm, an investment banking firm. How did what was maybe the spark, if you can remember? Was there any one thing, or was it the influence of Mr. Billings, or what was the spark that really got that ignited?
Sure. Well, there was one stop in between, which was in between starting FBR. The sort of the three of us came together at a very storied Washington-based investment firm called Johnston Lemon and Company.
Mm-hmm.
And Johnston Lemon, when we came together, had sort of evolved into a retail firm, but they had a number of innovative leaders, Jim Johnson, Jim Lemon, and then in the 50s had come up with this kind of crazy idea to start a mutual fund, which ended up being Washington Mutual Investors, which at one point was one of the 5 biggest mutual funds in the world.
Wow.
And also were very wise about their sort of core competence and sort of outsourced the investment management function to Cap Research in the West Coast, but kept some, business and other, sort of residual fees that came in over time. And so, we were part of an institutional group there, which is how Manny Friedman sort of entered the case, because we became kind of the institutional research boutique part of Johnston Lemon, and that's how we kind of came together and started thinking about where we could, have a stock picking business, sell it to institutional investors, and be creative and innovative.
Excellent. So now, what was the sort of the genesis of the first day or the first couple weeks, the first couple months of FBR? What did that look like? And how did you ultimately decide, the trio, to say, like, look, I think we have enough. We know what we're doing here. Let's get out on our own.
So we had a wonderful experience at Johnston Lemon, and Jim Lemon was a terrific leader, and was really pleased to have us, be growing sort of institutional business. And as it evolved, we were what you would refer to today as sort of generalist stock pickers.
Okay.
So we had a group of very intelligent analysts that would, look for what we thought were mispriced securities. We would write research reports, and then we, in the old-fashioned way, mail them out, and then we would try to, get paid commissions from the mutual funds and investment counselors and others. But we then also got smarter about, like, maybe you also should sort of specialize. And so we ended up having a real edge in these savings and loans and the thrifts. And then that's right when Drexel was blowing up.
Mm-hmm.
And Drexel, who invented the high yield bond market, or what was called the junk market then,
Less attractive
had
name.
sort of abandoned, a whole sector of bank and savings and loan and high yield preferreds and bonds. And so, we started to develop a sort of a trading capability, not just in equities and over the counter securities, but in fixed income and all of that. All of that was sort of blowing up at the same time. And so we really specialized in S&Ls, and we realized in order for us to really grow, we needed more capital. And there was a risk component to that. In hindsight, if I was Jim Lemon, I wouldn't have been comfortable with that either. And so, those kind of entrepreneurial sort of spirit was driving in all of us, and we felt like we needed more capital and probably needed to take more risk. But there was a real business there. We had revenues, and we just needed to grow it. And so we spent probably 12, 15 months trying to get a third party to back us, and nobody would. So finally, in 1989, we cobbled together what little bit of capital we had. We got a small little bank guarantee, and we ventured out on our own.
Wow. That's an amazing sort of origin story for FBR, not sort of, but amazing origin story for FBR. And maybe just to add one thing for everybody out there, either watching or listening, if you go online, you mentioned Peter Lynch. If you go online, you can see clips of Peter Lynch talking at FBR seminars that are on YouTube, talking about different companies. And I think those are good master classes in stock picking. And Peter Lynch, obviously a great stock picker at Magellan and at Fidelity. So now back to the early days of FBR. So you launch on your own, didn't get the third-party backing, bootstrapped it. It sounds like it yourself. What's the first year to maybe 3 years look like at FBR?
So back to having an edge, and I talked a little bit about that at the summit this weekend, and I think it's a word that we all should sort of, a little four-letter word that we should actually look at and repeat, as opposed to maybe some four-letter words we shouldn't repeat. Because, so what was the edge? And we clearly had an edge in the financial institutions. And in hindsight, when we started, if you classically looked at it by any standard, you'd say it was the worst time to ever start, because 1989 was the beginning of the big sort of bank-led recession that it really crushed the market in 90, crushed the market in 91. It was led by the dismantling of the banks. All the big banks had what were called HLT loans, highly leveraged transactions. They were all hung with loans that they couldn't sell, with the market sort of coming unglued. And the industry that we understood the best in theory, although we still had some generalists and we did other research and outside of banks and savings and loans, was coming unglued. But there's an old saying on Wall Street: bulls make money, bears make money, and pigs get slaughtered.
Right.
And so we quickly realized that the industry we knew best was coming unglued. And I think for us now, and I'd say a core principle for everyone, is you have to be true to your principle, which is we needed to advise our clients, our best advice, irrespective of the outcome. And so we were one of the first people to really put a sell recommendation out on the entire industry.
Wow.
And then our research was pretty good. And so a lot of the hedge funds and the more aggressive trading firms, started to seek us out, wanting our advice on which company was next, which company was next. And this next piece is another sort of vignette of sometimes it's better to be lucky than good. And so when you think about equities and you think about other securities, everybody understands you can buy a security, you can short a security, and that's kind of how it works. But one of the all-time greatest asymmetric trades started emerging then, and it just was happenstance occurred to us, which was the big banks. Primarily, but all the financial institutions had holding companies, and they all had a highly rated subordinated debt and debentures and preferreds, and they all traded at very tight spreads over treasuries. And even when the market was coming unglued, the fixed income market, much like what happened in 2008, 2009, they just looked at the ratings and they ignored what's going on, what was going on, sort of in the underpinning. And so we had a client who just one day just called up and said, I want to sell some, Bank of New England 9.75. I said, okay, fine. How much do you want to sell? $2 million. And I said, Scott, you own these bonds? He goes, no, I'm shorting them.
Oh, wow.
And he goes, I said, you can short bonds like that? He goes, yeah, sure. They're easy to borrow. They trade like water, blah, blah, blah. And so that was a big break for us, because we quickly assessed and understood that, really being able to build a portfolio of these, Bank of Boston, Bank of New England, Citicorp, Chemical, Manny Hanny. It really didn't matter because all Maryland National Corp, because they all ended up they basically all ended up coming to the T's of going out of business. And so bonds, which you could trade, which you could put on at at dollar prices of 102, 103, 104, they couldn't go up.
Right.
So all you had to service was the coupon if you hold on to it. And a lot of those bonds went to 5, 10, 15 cents on a dollar.
Wow.
So back to sort of risk reward asymmetric, the beautiful thing about that is the problem with shorting anything is you can only make a certain amount and you can lose unlimited.
Right.
With building a portfolio of these bonds, you could take a much bigger position.
Yes.
And it was really kind of one of the launching pads where, we started getting a following and people were like, those guys in Washington really know the
They're doing
financial
something.
institution, these things. And so that was one important component because when everybody else was really reeling in, 89, 90, 91, 92, our firm was growing, we were profitable, we were making our clients money, and we were, learning every single day about new and innovative ways to sort of take advantage of what the market will give you.
So from my memory, there was a structure of the co-CEOs.
Correct.
Could you maybe mention that? And some firms do that now. Carlyle was successful with that, and
Sure.
Other firms have been successful with that. Netflix is a more recent example.
Yeah.
How did that work for the three of you, and what advice would you give other people about having that type of structure?
Well, I think every business is different, and the reality is we, emerged in a period where I can remember like yesterday when we sort of kicking and screaming wrote the check to bring a Bloomberg terminal on because
they're still expensive.
Yes, because the markets were much more inefficient and the information flow was much more inefficient, and so the way that you flattened that information curve was you all basically operated in one big room. So Manny, Eric, and I sat next to each other, on a trading desk for a long time.
Nice.
And as the business was primarily a secondary business, research, sales, and trading, and you obviously had analysts sort of cordoned off, and you had compliance from day one. We did everything together, and so what do you call each other? Co. It's just no big deal. We all sort of did anything, and then as the business evolved and grew, and we built a major investment banking platform, and started creating vehicles and hedge fund and private equity vehicles, and started an asset management business. By definition, you have to kind of you have to segment out and take individual responsibilities. And so there's no one perfect structure.
Right.
I'd say it worked well for us, and it can work for very big companies. It can work for small emerging companies, but it doesn't work for every company, which is why most companies have a single point of accountability.
Right. Well, thanks for sharing that. So now maybe let's just talk about your time specifically there, and what you were most proud of, or what was the most interesting part about being there before we move on to Ramsey Asset Management.
Well, we'd need another couple of days to go through everything that I'm proud of. But listen, in financial firms, the assets walk out the door every day, right?
Yeah.
Because the assets are the people, and I think we were incredibly fortunate to surround ourselves, and I can't name all couple thousand people in the early days, but to bring on really capable people that were passionate as we were of trying to build a business and create solutions for our clients. Ultimately we were entirely customer centric,
right?
Because if the clients weren't receiving value from the relation with us, there's no reason they need to pick up the phone or take our call or listen to one of our roadshow deals. And so, I'm just proud of the tenacity that we built and the adjustments that we made. And so, you've kind of gone through a little bit of a chronology of this is my life, Russ. But then the world changes all the time. And so in August of 1994, you'd come through one of these great sort of restructuring periods, and there'd been lots of different efforts, and we had taken sort of our restructuring and our capital solutions skills from savings and loans to real estate. I mean, we part of the first public REITs ever done. And it's hard for people to believe, but there was no public REIT industry in that period of time. And so the whole equitization of the real estate business, which had been entirely a privately owned sort of business at that point. In the energy space, which is going through all its different sort of restructurings and iterations, but capital intensive, need real capital. But then August of '94, Netscape came public, and that stock was priced at 22 and opened at 78, and everybody's like, well, what's Netscape, and then what's the internet?
Yeah.
And so I know you want to talk about it, but I think there's a lot of analogies and similarities between 94, 95 and what we've seen in 21, 22 with open AI and ChatGPT and this whole as we speak, this whole feeding frenzy to get the infrastructure built out for the future and current industry of artificial intelligence. So that necessitated another shift for us. We were very fortunate to be in the middle of then what was a pretty entrepreneurial tech center environment, as you probably know. Even though we were a global firm, ultimately we were still headquartered here in Virginia. And the early days of Netscape and then the early days of AOL led to what really was the fiber and the investment in the ground that has resulted in today, which is 40% of the world's internet traffic goes right through Dulles Airport. And so we became a sort of a major technology hub, and we built businesses to help facilitate a lot of the capital needs for those businesses.
Yeah, and you all built a technology practice, and you built a lot of tech bankers and did a lot of sort of the deals that people would remember and took companies public that people would remember from the heydays of technology. And as you mentioned, part of that fabric was built right here, AOL, and now, as you mentioned, if you drive out to Loudoun County, it's full of servers.
Yes.
Which we're going to put a pin in and come back to on the AI piece, because that is part of that infrastructure, which is local. Well, thanks for sharing that. We could do a whole episode, which we should probably do a whole episode just on FBR at some point.
Sure.
So we can spend a little bit more time on it. So the next piece, so you did some asset management, as you mentioned, at FBR as you built out the business. At 2001, if I have my date correct, you left and founded Ramsey Asset Management, or that time frame is around there. I don't know the day you left or anything. But in that time frame, you built Ramsey Asset Management. Could you talk a little bit about that and talk maybe about why you wanted to build an asset management company at that point?
Sure. I mean, anybody in the business will understand this, but if you kind of start on the sell side, and even if in our case, we're very fortunate to become a principal firm and went public in 97, and some of the rules changed that allowed banks to both own and invest in brokerage firms. And so most of our competitors sold out, and we chose to go public in a partnership with PNC, which is a wonderful firm. And at the time, actually was the majority shareholder of BlackRock.
Yeah, for a long time they were.
For a long time, the majority shareholder of BlackRock. And so, for me, as I thought about my beginnings and kind of how I came about creating solutions for clients, I just enjoyed the idea and the challenge of wanting to just be a principal in a partnership.
Yeah,
and I always felt like the best then structural way to run money was to have a partnership with an unconstrained investment universe. The ability to sort of lever the asset side of the balance sheet, appropriately.
Yeah.
And then to not just have market hedge, but to be able to, look for individual companies on a fundamental basis that were either flawed or, fundamentally overpriced or had structural issues that were going to necessitate, irrespective of what happened to the market, necessitate, a re-rating of the stock and it would go down. So I always felt the ability to make money in your longs, make money in your shorts, and have a little bit of a market hedge and sort of move your exposures around was just a great way to run money and to run capital. And so in 2001, Manny and Eric and I sort of talked about it and kicked things around. And I could have done it inside the firm, which is possible. But at that time, the firm was very focused on building the investment banking franchises and growing. And even though I could go over in a corner or a different floor and do it, I felt like it was kind of all or nothing. So I did a JV with the firm, took some capital from the firm, put in our own capital, and started with what was and even now was sort of the structure that I just described.
Right.
And it's what we've been doing since for the last 25 years.
Right. And then maybe talk about, so for some people who are not as familiar with the buy side and the sell side, I think a lot of listeners would. What are the elements that you enjoy about the buy side that are not really offered by the sell side?
Well, sure. So I mean, broadly defined, the buy side is any customer of Wall Street, and by definition, the incentives are slightly different because in our case, we ended up having several different strategies, but in our case, we wanted our family to be the biggest investor in the fund.
Okay.
So we eat our own cooking.
Yeah, it's important. Alignment of interest.
We wanted to think longer term, which Wall Street by definition can be a short term oriented.
Can be quarter to quarter for sure.
Long term oriented. We wanted to be compensated if we perform.
Mm-hmm.
So there's all kinds of different fee structures, but we wanted basically a very modest sort of management fee, and then we wanted a performance fee if we performed.
Right.
And the biggest component was to be able to think longer term,
mm-hmm.
and to not have the vagaries of month to month, quarter to quarter,
right?
Which is a hugely important element. That's why liquidity providers exist. Is why trading desks exist. Is
right.
why investment banks exist. But just wanted to express that on a principle basis.
Yeah.
And then obviously many of the folks that I came to know well and respect were hedge fund managers or
mm-hmm.
mutual fund managers or investment counselors, and it seemed like a good way
natural fit.
Nice. Yeah, natural fit.
And you spoke about having an edge, and it sounds like part of that edge. Correct me if I'm misunderstanding this. Part of the edge in that setup is to actually take a long-term time horizon. Whereas a lot of the Wall Street focused setups are really focused on what's going to happen next quarter. Are they going to meet and beat earnings and guide higher? When you think about the long term in that structure, what's long term for that type of setup? Is that 1 year? Is that 5 years? Is that 10 years? And how do you express that?
Well, our first fund, which we called Capital Crossover Partners, which I still think was probably I think it was probably the best vehicle for both us and for the investors, was a 10-year fund. It had 5 years of recycle where we could,
mm-hmm.
make an investment, get the capital back, recycle
right.
it. So investors had an option to stay with us 10 years, but they could they could redeem their capital after 5 years. And we had an unconstrained investment universe.
Okay.
So unconstrained in terms of industry type.
Okay.
And then unconstrained in terms of where in the capital structure that we could invest. And so it gave us the flexibility to sort of invest in debt securities,
right?
At the right point in time.
Mm-hmm.
We called it crossover partners because at the time there were some very lucrative opportunities to make going public securities to invest in companies, which obviously I knew the IPO and,
right.
and
process.
markets very well. Yeah. When we started, we didn't anticipate Enron, we didn't anticipate WorldCom, yeah. We didn't anticipate a lot of the things that created some real distress in the debt markets, right. Which ended up being quite good to us. And so it gave us multiple tools, which I think, as an investor, someone evaluating us as an entity, I believe that gave us an edge
yeah.
over our competitors because back to the example of the asymmetric trades with the bank shorts and the bank bonds, it gave us an opportunity to be very opportunistic.
Mm-hmm. So I'm going to put a pin in the investment piece. So you maintain Ramsey Asset Management today, and you continue to run that today. So I want to put a pin in that. We're going to come back to that to talk about some of the AI ideas that you mentioned a little bit earlier. But I want to take a small segue here to talk about GW, back to GW now, a little bit about the Investment
Mm-hmm.
Institute. So you served as chair of the board for a full term, which everyone is grateful for, and thank you for your service as chair of the full board at GW. But maybe talk a little bit about that, just as maybe a primer, your time as chair. But then, having this idea to start something, what became the Investment Institute. Could you just talk a little bit about that? And many people have heard this story, but certainly we want to get this memorialized a little bit to talk about sort of that foundational idea of, having students run money seems what we've talked about before. It seems like a terrible business plan. When we hire and fire analysts every 15 weeks. But this idea has led to many great things, and certainly been a great benefit to us. So maybe again, first start with a little bit of context. Board chair for a long time at GW, and then this idea to start the Investment Institute.
Sure. So I'll work backwards. So as you mentioned, I was privileged to serve 2 terms as chair, which I termed out in 2013. And I say termed out because I'm also proud that I put in term limits when I was there, because one of the great privileges of my life was having the opportunity to serve as a trustee and to invest in what I hope is the future, healthy future, and the direction of the university. And so as an entrepreneur, I've been fortunate to be around a number of different businesses, but when you sort of are charged with governance of a couple of 100-year-old institution that will almost certainly be here a couple 100 years from now, you sort of think a little differently about lots of things. And so prior to that, I think I'd come on as a board member in 97 or 98. And so as part of that, you take on different responsibilities. And so I learned a lot about how the whole university worked. And then when you and I first met, we were kind of iterating, going through bringing the management of the endowment in-house, because we had a relatively small endowment. It was managed by third-party managers, and it was advised by one advisor. And I think we felt like we could probably do a better job bringing it in-house, having a single point of accountability with the chief investment officer, and sort of building out intelligently sort of that for the purposes of trying to maximize performance. And so I had the privilege of trying to set up that investment office, and made the first hire of Don Lindsay, who deserves great credit in being willing to actually put his reputation on the line for this class.
Yes,
going
absolutely.
Back when we first started it. And so, when you iterate through, multiple years of an investment endowment, which an endowment by definition is permanent capital.
Right.
It has a payout to support operations. So the capital preservation is very important. But the enemies to that endowment are obviously inflation and payout. And so just to stay even, however you look at and think about it, payout and endowment, you've got to be making 7, 8, 9% a year. And so in order to do that, you have to be very thoughtful about both asset allocation and also about sort of net returns.
Right.
And so it was a particular pet peeve of Don's that we had at the time, and most endowments today, well, not most, but many do still have the largest allocation to some type of a liquid strategy or an equity strategy, and that we weren't keeping pace with the S&P 500. Now, SPY has been a big star this last 7, 8 years, but even throughout the S&P 500 was kind of the bogey that you had to really kind of use as a bogey. And so it was just like, why can't these highly paid managers outperform the S&P 500? And so we literally sat around brainstorming and said, why don't we set up a class and give the students the basic outlines, mirror Buffett and Munger, and keep the textbooks very straightforward, and let's see how it goes.
Well, I'll touch on the investment office a little bit, because I work there, and that's how I first met you as chair of the board and heading the investment committee and building this function internally at GW, which I am grateful for too. And I'll mention Don Lindsay as well. And so I try to keep up with Don. I haven't talked to him so recently, but not that long ago. And just to let him know, I'm grateful for the opportunities he gave me. But I think it was a fantastic setup, sort of, to do a little bit of nostalgia. And when I was there, I started when we were about 550 million, and I left to come over to the business school when we were about $1.5 billion. So I think your idea worked there as well. And so I think that was a fabulous setup. And I think that structure that you put in place is super important. And I think that's one of the things that is, for any institution, having someone who knows the markets, someone who knows that world. I think it's really important for someone like that to be the champion to do something like that and that activity. Because as you mentioned, it is a hundreds of years old institution. you got to bring that special knowledge to bear, I think, to do something like that. So give you a lot of credit, which you deserve when you set that up. And obviously, I benefited that directly, and I had a great time in my time at the investment office over 7 years. I was a generalist. We covered everything. That's how Don set it up. So I think it was a fabulous run. Had a wonderful time. Certainly helped the university make hundreds of millions of dollars. We won't take credit for the real estate, but outside of the real estate, we absolutely performed well and did really interesting and fun things that benefited, I think, the university. So to the class, I served as the first teaching assistant, as you probably remember, and Ethan McAfee at the time was the director of research.
Was
at
another
Ramsey.
key person in this because he had got the bit in his mouth where he went undergrad at Virginia Tech.
Yeah.
So Virginia Tech deserves a little shout out here.
Yeah, absolutely.
Because he had gone through their program, and it was what got him his first job at T. Rowe Price, which is where he was prior to he was the first internet analyst at T. Rowe Price, and was and is a very differentiated thinker and a clearly talented, very, very talented professional, and had a lot of passion to come in and teach the students.
Absolutely. So I'm grateful to Ethan McAfee and grateful for you and Don. And I was sort of the last person on that ship as TA, but I was working for the investment office. But I think that was foundationally, I think we were designed for success at that point. And I think we talked about, well, there's limitations, certainly, if you say, okay, well, we're going to seed this class. You and Norma said, we're going to, after these discussions that you and Don had and Ethan, we're going to seed this class. Don and company are going to run this class. Don and Ethan and company, I was in company at that point, are going to run this class. And, we're going to have a pretty straightforward setup. As you mentioned, it's going to be single security analysis. So we're going to teach students really how to pick stocks. And we talked about that a little bit at the summit. It's less about portfolio management at this point because, you're dealing with new analysts. Step one is, look, we're going to have to train you on how to understand a business. And then what are the tools to do that? And as you mentioned, we use Buffett. So we talk about the business, we talk about the management, we talk about the valuation of the company, and we talk about the balance sheet. And the balance sheet's the piece that we added that Buffett doesn't explicitly write about in 1993 annual letters where we stole that from. And so, really those are the teachings. But, what are your ideas about, so far, and we can fast forward if you like, but certainly the thing grew and evolved over time. How do you think this thing has worked and what were your initial goals? And do you think that those goals have been achieved?
So there's a few things there. So I'll sort of try to take them one at a time.
Sure.
So in terms of looking back 19 years ago, I would say I had very modest expectations. And while we made the gift and we set things up, I'm not sure I had any terrific projection of like how things would go.
Okay.
And
which is probably appropriate at that point.
Yeah. Having said that, I firmly believe that the impediments that we eliminated, which are a detriment to our performance, were real and have proven themselves out, which is over trading,
right?
Short-term reaction to news, pressure to keep up with indexes and peers on monthly and quarterly reporting,
right?
Threat of redemptions, which comes from sort of underperformance or bad performance, and then just the idea that we're here for the long term. Just those alone, I felt like we probably had a good shot of at least not blowing up the Capitol,
which is a good initial goal.
Yes, a good initial goal. I think what has emerged, and I think there's some things that are even more amazing when you look at the performance, and you can actually educate our listeners on the performance of the fund as well. But I think an even more amazing outcome is, to your point, the class is designed to teach stock pickers,
right? Not
to be portfolio managers. And so just the construct of the fund, it's even more amazing in the sense that the big outperformers, Apple, NVIDIA, Microsoft, Visa,
right?
They've all outperformed without additional capital going in.
Correct.
Okay, which is even more amazing. So you don't go from 0 to 8%. You go to a very small percentage, and that has just by leaving it there, letting your winners run, not having the constraints of, oh no, it's no longer now a mid cap because I got to sell it because I have a mid cap mandate. It's now too big. Oh, it's more than 10%, so I got to sell it because it's mandate. So without those constraints, now the sword can go both ways,
of course,
and we know that.
Yes,
but I think it goes to the art of getting this individual security selections right, and to some degree the value of the peer review, right? So
absolutely,
you can maybe educate our listeners on how the actual stock picking process works.
Sure. So, and I think this gets to this point is that there's a little bit of the wisdom of crowd happening here. So we have classes, of 20 to 25 students who pick these undergrad and grad. And now, for everybody, the Investment Institute's over 10 million. If you go onto our webpage, just Google GW Investment Institute, you can get our quarterly reports where we publish our returns. So it's very transparent, good and bad days,
Yes, right.
and our top positions. And we'll talk some about those. You mentioned a couple already here. And so the students go through the semester, and this is a 15-week course, the standard course as any other university. It's a 3-credit class, just for those who are interested in that. And it's a rigorous class, though. It's a lot of work. So we're part of this is it simulates having an internship basically on a Wall Street type of investment research desk, where the expectations are that, okay, you're going to do first, you're going to do a sector presentation with your team. So you got to work within the constructs of a team. We collapse a couple sectors down. So we have 6. And so you're going to be on tech, or you're going to be in healthcare, or you're going to be in consumer as examples.
Yep.
You make that pitch, you come up with a sector thesis, and that kind of sets the table of like, where would you like to take the portfolio? And then make sure you understand the current positions that we have. We have about 50 positions. So we're about 1/10 of the S&P, but we're highly concentrated within that, which we can talk about, but 50 positions overall. And I think the students do an excellent job at that point, but it helps them get sorted. They do a very rigorous weekly analysis. We have access to Bloomberg FactSet now, and also our students are using, thanks to Oscar Polito, shout out Aladdin, which is the risk and analytics system that BlackRock uses. And so we have these tools that students use, and then, okay, we get into, you're going to make one recommendation, and this gets into the overtrading piece. Students only make one recommendation per semester. So everyone can see us coming at the end of the semester for doing trading. No one's picked up on it. I don't think anyone's really front running us yet, but I don't think we're quite big enough for that. But maybe Jane Street and others are. Who knows? So it really, all of that work, that 15 weeks, and this was at the inception, we want to maximize the amount of intelligence that you put into one idea for one semester, and make it the best possible. And then the peer review, as you mentioned, is that they have to garner 80% of their peers to get that into the portfolio. And some say, well, why 80%? That is, for an investment committee, which we tell students, like, I ask them, like, what do you think the percent is for an investment committee to agree for something to go into the portfolio? And they usually rightly guess 100%. It's like, yeah, you don't have an investment committee where there's a lot of dissension. It's like, well, that's not the point, right? It's like, we have to uncover these things. If there's dissension, let's tackle that. Why we make it 80 is because within the construct of this class in 15 weeks, maybe somebody doesn't like somebody's outfit that day, or whatever the reason is. So we cut out 20% out to allow for sort of outlier disagreements or lack of understanding. Maybe it was too quick or whatever that happens to be. And so we try to accommodate for that piece. But otherwise, you have to get the vast majority of your peers, which would function just like a regular investment committee. And that's what they serve as the collective. So there is some portfolio management happening at the collective level, but not at the individual level. And so that's tough, because we've definitely had bad ideas coming in and out of the sort of pitch days. But most of them actually get voted out. They just do not ever make it into the portfolio. They never make it in, rather, they don't get voted in. We only have 1 0 in the life, 19 years. There's only been 1 0 in
what
the
was
fund.
that?
That's Freddie Mac.
Okay.
We're still waiting, maybe.
Yeah.
But there's only been 1 0 to speak of. And not that we can't have a 0 from here. As you mentioned, the market humbles you, and you learn every day. But so far, the performance has been good. And so what that has led to, and again, people can find our performance online, but we're compounding, 10 years at over 13%, 20 years or 20% for the last few years. And so these are exceptional numbers for when you consider who the analysts are. So most of our students have no experience at all in this world. They're taking this class to learn. And that's the primary objective. And that's what we're there for. The performance is definitely, I think, a surprise a little bit for all of us to be at this level. But it goes to the point of, well, when you start solving some of these problems, well, maybe that's the key to our performance. Number one, we know that we have to have some process, and we developed that process from day one to say, okay, look, we're going to train the students to look at the companies in this same format. You're going to rate these, and you're going to pitch it to those, and we're going to be looking for high quality business. That has been the hallmark.
And how do you screen? How do the students screen when they for names?
Yeah, so that's where you're using Bloomberg, you're using a FactSet, and what we're telling students to do is look for high quality opportunities. So what we're looking for is some of the classic, maybe more modern day Buffett, certainly Peter Lynch, and this type of a company where we want a high quality business with a business that has high returns on equity, ideally capital light, so not very capital intensive, but we cross all sectors. So if you're in industrials, that's not always the case. But if you're in consumer, how do you find a consumer business that's capital light? You try to go out there and you find that. You think about Costco, which we own, it's a large position as an example. The way that they manage their inventory, and so we're trying to train students look for those outstanding businesses. And then on the management side, this comes from Buffett. Do you believe in what this management says? Do you think that they're good stewards of this? Do they have a good track record? And looking at their capital allocation, we use an acronym for that called CAPITAL, but it's really about how do they allocate capital? Have they been efficient? Have they been effective? Or have they just done, 10 acquisitions and paid in stock and really sort of depressed the whole cap table for everybody? And that gets into the balance sheet. And it's like, okay, yes, the company's bigger, but it's less profitable. Returns to shareholders have been mediocre, maybe at best. Maybe this is an empire builder management team and they're not, really focused on the shareholders. And that's where we get into, okay, go look at the proxy statements. How is management compensated? And making sure that we're aligned as minority shareholders, because generally speaking, Tim Cook doesn't take our calls, even though for us it's a big position.
Right.
And Jensen Huang doesn't either right now. But we have to think, okay, well, without talking to this management team, how can we be assured?
Right.
We can't be fully assured, but how can we best understand? Well, if the alignment is there and their interest is aligned with ours, well, then that's probably at least a good start down that path. And on the valuation, this is probably one of the most challenging things where, we started, I would say, leaning more towards Buffett. So a lot of our earlier companies, but Apple is one of the first companies we bought, which is over 100 bagger, just for everybody. And we bought it in 2005 and did the Charlie Munger, sat on our hands. We did trim that once. And it's been over 100 bagger. So that's been great. And Tim Cook has been a cash machine for that business. So that part is challenging because all the metrics, and we've talked about this a little bit before, all the metrics, and I'd love to hear your thoughts on this, all the metrics that you use for valuation from, early days, let's say Buffett when he was working at Graham Newman, and you're looking at these nets and you're looking at PEs and you're saying like, let's find stuff that's cheap, in the classic sense, these cigar butts. Well, hasn't really worked on the types of companies that have really succeeded now.
Right.
Amazon is given as an example that many people use where, since IPO, and you had some periods where they sold off, but at a lot of different points, Amazon was cheap.
Right.
If you bought it and you would have done well, obviously you make more depending on where you go, but you would have still done very well almost all along the way. So I'm curious on this valuation piece in particular, and we'll mention the balance sheet, but how do we, think about that moving forward? And for people out there who are, maybe trying to learn how to invest or how to follow companies, how do you think about valuation nowadays versus, sort of the classic, let's find a cheap PE?
Well, the art of valuation, in my judgment, is indeed that it's the art of valuation, and so I. In the types of businesses that we like to invest in, which are similar to how you've set up the investment fund.
Yeah.
We try to dumb it down and keep it pretty simple as well, which is we like to look at the core returns in the business.
Right.
And that's unlevered returns, cash on cash returns, so return on assets as well as return on equity.
Yes.
And then what we, really want to spend time looking at is, how does management think about those free cash flows and the reinvestment rates of those free cash flows. And what you like is to have a business that has a natural sort of reinvestment rate. And so one of our biggest positions is a company called NBR, which is one of the best performing investments ever.
Yes.
But a company that was bankrupt in '92, that went through a Chapter 11, restructured, and came out. And the dollar price of the stock now is just under $10,000 a share.
Nice.
And it was 50 cents.
An excellent return.
Yes, and a share. But this is a business that was a very over-levered and low-margin and cyclical home builder.
Yeah.
Who now is, I think the 8th or 9th largest home builder in America.
Mm-hmm.
It's a $30 billion market cap. And they have stayed to a very straightforward model, which is they learned, which has got them into bankruptcy, and what they've learned subsequent to that is that they don't need to inventory and own their assets.
Mm-hmm.
They can option their raw material, which is primarily land.
Right.
And if they and it's viewed as a commodity business,
right,
that still has 50% return on equities,
which is crazy,
debt free, and they can simply build faster and more efficiently than their competitors.
Mm-hmm.
And more importantly, in a country, and they've had tailwinds now for the last 10 years because we, now for a decade haven't been making enough homes
right,
to just keep up with the inventory depleting and just the natural growth of demographic growth. So as they have, and they've never had an unprofitable year. So the last 25 years, they've never had an unprofitable year. So they weigh the cyclicality by being the biggest sort of builder in any one of their markets,
mm-hmm.
so having the most market share, and then just moving and adjusting with the market. So if the average price of the home moves up, they sort of follow behind.
Mm-hmm.
If we go through tougher times like we went, pre-COVID and even in COVID, you come down, and the point is, businesses, even if it's a so-called commodity business,
mm-hmm.
If the management, which the management has goes down almost to the administrative level in terms of how they compensate everyone in stock.
Okay.
And so everyone is very focused on the sort of the cash returns in the business, the reinvestment
mm-hmm.
rate, and in the case of NBR, when business gets slower and we have the cyclical economic downturns, they just slow the business down. They pay off their debt and they use all their excess cash to buy back stock. And it's a very simple model. And I think that's an example of, to me, the types of businesses that you'll never be disappointed in owning those kinds of businesses.
Right. So on the valuation side, you pay up at some points,
yes.
and that's
yes.
But those are the things, and I think that's something that we say is like the valuation is a part of it.
Valuation is a part of it, but you have to go beyond traditional metrics, right. Because traditional metrics, you say, oh my gosh, never pay more than 1.5 times book for a home builder. It's going to be capped at 10 PE. I mean, NVR has consistently traded at 4 to 5 times book value, and the stated PE is going to be in the high teens, low 20s. But it's a great business, and the biggest mistake that I've ever made is selling a single share.
Nice. Well, that happens.
Yeah.
And maybe just a follow-up question is, what's your favorite holding period for a company like this?
Well, it's not been forever, but it's been for 20 plus years, and that's a at this point in the cycle, I think it's a very interesting question, mm-hmm. because it's not. I think people make a mistake and say it's not what is my holding period that should be the question. It's like, what is the reinvestment option,
right, after
tax? And how is that going to be superior to the capital allocated in a particular company?
Yeah.
But so for the thoughtful stock picker, I think there's two types of research. There's primary research, which is how you kind of do everything you're doing to try to get to the point of pulling a trigger and owning something.
Yeah.
And then there's maintenance research. And so I think with maintenance research, you always have to be gauging what's different. Has succession plans been put in place, and will the next generation be as cold-blooded and attentive as the previous? Is the moat widening or right. narrowing? And I mean, is that edge? Is that edge still there? And it's going to show up it's going to generally show up in the returns,
right?
And it's going to show up and is the communication style that comes from management. Do you use NVR as an example? For example, they don't do quarterly calls. They don't do projections. They don't talk to Wall Street. They put out a quarterly release. They put out an annual report, and
so a little bit like Berkshire Hathaway style.
Very similar. Yeah, they don't have a big annual meeting, but they have an annual meeting.
Yeah.
But it's keep it simple, stupid, and don't detract from what the core comes. But I think you have to pay attention to the industry.
Yeah.
And on the margin, and I can't think of a great example right now, but there's many examples of companies that had great businesses, and the world changed, and all of a sudden their great businesses became not great businesses.
Oh, Research in Motion, would be an example.
That's a very good example.
The BlackBerry, which everyone, if you looked back, when in their heyday, you would be like, oh, well, they own the world, and who's going to disintermediate this? And even when the iPhone came out, it was like, oh, that's a personal device. It's not really, business is not going to use that. And so,
Tupperware, one of the great brands in America, and it's bankrupt.
And so, so you do have to be rigorous in your analysis and the maintenance research, as you mentioned. And so, I want to just wrap on the Institute for one moment, because I want to go back to AI. But to tie those two things together is around this artificial intelligence. And we mentioned that a little bit earlier. And so our largest position for the Investment Institute right now is NVIDIA. And that, as you mentioned, is the result of an investment that happened.
Give us a quick history on NVIDIA. When did it go in the portfolio?
2019.
And why did it go in then?
So the analyst pitched it, and the grad funded. It's both in undergrad and grad. But the thesis, you go back and look, is very similar. One of the things that I think when you have fresh eyes look at these things, the analysts both saw this idea that AI could be play a big role. Now, to be clear, I don't think they predicted, ChatGPT. That's not certainly what I'm saying here. But I think when they saw that as a big growth market. Crypto was still something back then, as far as like the number of GPUs that they were selling into that market. But I think what they saw was a company that was run really well. Jensen Huang, if you really look at the management and how they're running, it's a very unique way that they run the company. And so when we go through the framework and you talk about the business, now the gross margins now are 70%, but they were not 70% then. They were good, but not where they are now. Jensen Huang, founder, CEO, so that was highly rated then, as it would be now. And a lot of confidence there, and they had done some interesting things to address the gaming market, to address the crypto market, and we're getting involved. I think earlier days in the server market, and I think that was part of that. So, but they had the foresight to see like, okay, there's lots of different shots on goals that NVIDIA could have, and again, they didn't predict ChatGPT. So, like you said, better lucky than good. I think that was partly luck. And of course, they have a rock, solid balance sheet, so that fit our equation too. Talking about unlevered, returns. We are always looking on the balance sheet to make sure that clean as possible. We're equity investors. We don't want to be too concerned about the opportunity to go bankrupt.
So it went in 2019.
2019,
and it was one buy.
One buy.
And went in at what % of the portfolio?
Probably like a 1 or 2%. Yeah,
okay. And today
like
it's what?
25%.
Okay, got it. So you haven't sold a share.
We haven't sold a share. And so that's something that we monitor, as you mentioned, sort of the maintenance research we monitor every day.
What would cause you to sell? What do you think would cause the either to be reduced or would it come out entirely of the portfolio?
No, I don't think we would do that. Somebody could recommend that. I think I would be reluctant to have that happen. So far, no one has proposed that as far as the student side. From the risk management side, which we're also in charge of, is sort of the administrators for the fund. I think to do something outside of that is to be worried about a specific part of their business or to see a real change in the margins. Again, these 70% margins were not always the case. And I think that's a real, if you talk about the bull case and the bear case that people like to do on any company, but specifically within NVIDIA, you can definitely see where, maybe this type of margin doesn't last. What would also change is, do you see a real threat coming into the business? So is Amazon building enough substitute chips that's pulling off some of their business? Is Google doing enough? Is Apple, going to take a bite out of this apple, so to speak? Pun intended. When you have 70% gross margins and 50 plus % net margins, it's going to attract attention and at this scale. So that's something that absolutely watching closely, and that would cause, I think, us to share, and certainly we've had analysts to do research even off cycle in the summers to really look at this, because I think that's a real concern, because when you have those margins jump up, it just
Yeah.
like any other business, it attracts a lot of attention. So when you get 70% gross margins, other people say, hey, we have smart people, maybe we can do this.
Yeah.
The challenge, I think, sort of the bull case then is the environment that they've built has been years in the making. So this is not an overnight success that they have this company. And Jensen Huang would talk about, and he's on another podcast called Acquired as an example, but he's on sort of a lot of media right now. But he talks about the company as a platform company, and if you hear those talk about it, that's how they'll mention it. And they built this software system, CUDA. It's sort of development tools and many other things, and that's a whole rabbit hole we can go down. But they've built an environment that looks a little bit like the environment that maybe Apple has built.
Yeah.
And so that's very defensible, and for Apple has been very defensible for a very long period of time.
Yep.
And so I think it's a big challenge for us and our students to really think about, it's become a very big position. We certainly don't want to rest on our laurels and think like, oh, it's going to, everything's great and it's going to continue to grow. But at the same time, we also don't want to sell shares unnecessarily if we think that this moat is going to widen in the next couple of years.
Right.
So, what's the right number? I don't know. These are things that we have to think about. It's definitely going to invite competition. I think that's inevitable. And I think you're already seeing some people trying to chip away at their lead because of the platform that they built and all the developers that they have on this system. Again, looks a little bit more analogous to an Apple ecosystem that they built for the people, but it's instead of a business to consumer, it's a business to business type of operation. Those things tend to be sticky. To switch out to some of the open source features is, I think, tougher for businesses when they're building these big data centers. So I think if we saw one of those things change, I think we would have to really think about, people were really migrating to another system, started using some of the more open source opportunities, real substitutes for the GPUs. But it's an arms race, it seems, at the moment. And so we talked a little bit about this, but question back to you is, where do you think this arms race is going? Maybe this is a lot of unproven spend. And that's another part of the thesis is right now their customers are the so-called hyperscalers. Those companies are full of money. And right now, they're just raising the price. But I think part of the thesis to say that that's going to continue, at least for the next 12, 18, maybe 24 months, is none of these companies want to fall behind.
Yeah. Well, I don't have a crystal ball. I do think that there's some similar analogies to what I described before about the 94, 95, 96, 97 timeframe in the beginning days of the internet, and what we're seeing with the beginning days of OpenAI and artificial intelligence. And much like Netscape opened up the world to with its browser, opened up the internet to the world. I think OpenAI with ChatGPT, of which now there's 5 or 6 other ones, but that was the first one that literally like that, went to 100 million users, and that's only been a couple of years now.
Right.
So that's sort of step number one. So, the potential, every day is magnified about what the potential for this tool for all of society is. So that's sort of number one. Number two, this massive amount of infrastructure build is just trying to keep up with the investments, building more language models, building more capabilities, and getting even more trained, what they call large language models, for the benefit of businesses and corporations.
Right.
But the list is almost unlimited as to what this potential power that could emerge in medical research and cancer diagnostics and anything that requires massive amounts of data to be computed and iterated on. It's going to be playing out in front of our eyes. So, I think the way that you try, as both as an investor and just as a member of society, is you pay real attention to the big four, and there's a couple more, but it's obviously Amazon, Google, Meta, and how am I blanking? And Microsoft that are responsible for 80-90% of the investments, and there's no stopping. There are impediments, which is I think something else to sort of pay attention to, that have investment implications, which is power is a real issue, and Microsoft. I think it's less extraordinary that Microsoft cut a deal with the owner of 3 Mile Island to restart it. I think the stunning piece of that is they paid twice the going commercial rate.
Wow.
way out into the future, which just, to me demonstrates the challenges of getting power.
Yep.
In that case, I think it was sole source power for just Microsoft. So I think you got to pay real attention to and utilities. There's been more information on the tape in the utilities in the last 4 weeks than I can remember in 40 years. And all of a sudden they're growth stocks, but their stocks are re-rating the commercial ones because they've got growth drivers they've never had before.
Yeah.
But I think you got to pay real attention to that. And then I think you got to pay real attention to where the power comes from, which is going to be very controversial, but it's going to have to come from restarting natural gas.
Yeah.
And so, I think there's probably some interesting pockets of opportunity within that whole sort of, that whole chain that exists there. And in terms of, what's next, I think you just have to you're going to have to really pay attention to models that are working and models that aren't. And we'll all have to be very flexible.
Thank you. So now we're going to move to wrap here. So thanks. We had a really wide-ranging conversation, and certainly inviting you back already. We can do a couple of sub-episodes if you don't mind at some point. But to wrap up here, to start with is, what do you think? We'll do some worldly wisdom after this, but just to wrap on the GW Investment Institute. Again, thank you for the vision that you've had, you and Norma, long ago, along with Don Lindsay and Ethan McAfee. I think, an all-star crew who started this, and I think we've developed something that has benefited many students. Now we have 1,400 students out there working in the world, and we had some of them back on campus, the Ramsey Scholars. And just to mention that to everybody, we have $50,000 every year set aside that comes out of the Ramsey Student Investment Fund, managed by students, that goes back to students. And now we've awarded over $600,000 back to students directly for their hard work in one of our classes, the leadership that they demonstrate. And again, we had some of them back on campus for alumni and family weekends here at GW, which I'm super proud of, and I know you're proud of. And it's been a real sort of passion project, I think, to build this institute, and certainly to connect with our students and now alums and who are succeeding and building their own careers and lives. And we're super proud to be part of their journey. So now maybe talk about, what do you think is the future for the Institute? So we've done the 1 to 10, that's so-called 10X, which the market could take back from us today.
Sure.
But we did it for the start. What's the vision? Where should we go from here?
Well, I think we just keep reinvesting in our winners. I think we have a model that works. I think we just need to keep improving it on the margin. And I think we need to make sure everybody knows what we're doing, so that we can invite both skeptics, supporters, and others who want to be part of. We still call it an experiment, but it's 19 years in the making. And I believe we just need to keep doing what we're doing, executing, keeping the eye on the ball.
Well, that's
hustling.
Good. Keep hustling, which Oscar Polito, one of our keynote speaker this weekend, mentioned. Shout out to Oscar and The Bid, his podcast. So thanks for that. And I know, again, I'm grateful. All of our students are current students are grateful, and the alums who benefited from taking one of these classes is grateful. Now, maybe to wrap, any just worldly wisdom, things that we should think about, not just as investors, as people, but could be just as an investor, things that we should be considering, thinking about to close us.
Well, Rodney, I think the best thing I can do is just thank you for your commitment and what you have done to build this place, not just as a place of intellectual curiosity and execution, but a place really filled with smiles and happiness and a zest for the future. And I would, it is a model that I talk to my children about, and anyone who's interested. So I would just say my best wisdom is to keep doing what you're doing.
Thanks. Well, that means a lot. Thank you. That's so nice of you to say. I feel very fortunate and honored to be in charge of the Investment Institute. I think it is a special magic that we've created from all the hard work we've put in, and all these great people, including yourself and others, that really commit time, energy, effort, money into this, and our advisory board for the Investment Institute as well. And so I'm honored to be running it, and thank you for saying that. It means a lot. So thank you, Russ. Thanks for being a guest on Market News with Rodney Lake. And now to wrap, thank you for this episode of Market News with Rodney Lake. Just a reminder, this is not investment advice. This is for educational and entertainment purposes only. Thank you very much, and see you on the next episode. Disclaimer: the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guests and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.